Let's move into our first session on private equity. With me, I have Stephen from Apollo, and Stephen Beckett from Apollo, and Tom DeHart from BlackRock. And we're going to first start talking a little bit about what is private equity, and why should we think of investing in private equity, and then we'll go deep dive on how do they make money, and what are the opportunities to invest in private equity. So Steve, let's start with you. Just introduce your firm to everyone. Everyone has heard the name Apollo, but they may not be very familiar with Apollo.
Sure. Apollo is a leading global alternative asset manager based out of New York City. We'd say we're probably the largest true alternative-only asset manager in the world. We manage about $550 billion worth of assets across credit or equity, yield, and credit. Equity meaning private equity. We were started about in 1990, so 34 years ago, as a private equity firm. And so it's our DNA. This is what we do. And I wanted to apologize as to start out. You'll see Corey Calvert's name on there. Corey is one of our teammates who was supposed to actually be here to do this, but due to unforeseen travel circumstances wasn't able to be here. So you get me. So hopefully I can fill his shoes for you.
All right, so Tom, please introduce BlackRock. Everyone's heard the name BlackRock. They don't, meaning until we started looking at BlackRock deeply, we didn't understand how big is BlackRock.
Sure.
Pretty big.
Absolutely. So BlackRock is the world's largest asset manager. We are pure fiduciary for our clients. We deliver whole portfolio solutions across institutional clients and high net worth investors as well. As you mentioned, many people are familiar with the name, and iShares, a lot of what we do on the public market side, our technology systems, Aladdin, et cetera. What you may not be aware of, though, is that BlackRock also has one of the largest and leading alts platforms in the world. We have established and growing businesses across private equity and private credit, infrastructure, real estate, and hedge funds as well. Within the private equity pillar, I represent the firm's private equity solutions group, and those who have invested in our private opportunities fund, our direct co-investment offering. We're the group within the firm that's responsible for those activities. So today we manage approximately $46 billion in private equity commitments since inception, and our team of 60 investors around the world are responsible for making commitments to private equity primary funds, essentially investing in the best GPs in our opinion, and their funds. We have an established and growing co-investment business where we've committed over $13 billion of capital into 300 investments over the last 20 years. And we have a secondaries and liquidity solutions business as well. So we deliver all of those investment types to our clients, both through our commingled funds, our evergreen solutions, and then our custom accounts. The democratization of alts is really important. It's one of the reasons why we're here today. And what BlackRock's strategy is to take all of these resources and all of this experience that we manage money on behalf of institutions and now bring it to high net worth investors across the country and around the world.
All right. So now that we know who's Apollo and who is BlackRock, can we now talk about, we keep hearing private equity has a lot of money, private equity bought this, private equity bought this, that, and these companies are making a lot of money. Can you talk a little bit about the opportunities for Apollo and BlackRock and other managers in the private equity space? What are the opportunities for invest from your side, from the firm side? Sure.
Okay.
Why don't Tom, you start first?
Sure. So sort of market environment opportunities. I think there was a mention earlier around the champagne. And if we were sitting on this stage 12 months ago, we'd want to bring out the champagne because private equity sort of hit the trifecta in 2021. And what I mean by that is essentially the most amount of capital ever deployed or invested, the most amount of capital ever fundraised, and the most amount of capital ever distributed back to limited partners. That was 2021. Obviously, very savvy general partners, these managers of private equity funds, they basically sold everything that wasn't nailed down, and then they returned the capital to investors and very, very good returns. And those GPs that didn't sell the companies, oftentimes they were opportunistically then refinancing the businesses to take advantage of the buoyant credit markets, to lower their average cost of debt, to push out their debt maturities and really prepare for the change of the sort of turn of the cycle. Obviously, the cycle turned, and it turned hard in 2022. And what we saw was basically a perfect storm, right, for all investors, as we just heard from Torsten, but private equity in particular. And what you found was the fact that suddenly private equity general partners had to deal with increasing rates, inflation, labor shortages, increasing commodity costs, geopolitical risks, and then also, as we moved through the year last year, the threat of a recession. So what happened was, I think the public markets adjusted very rapidly to that. You saw valuations come down. In the private markets, and private equity in particular, what you saw was a gapping out or a widening of expectations between what sellers were expecting, they were still living in the 2021 environment, high multiples, and what buyers were actually willing to pay, which was significantly less. A lot of general partners were focused on their existing private equity funds and then opportunistically making investments as well. 2023, it's been dynamic. I would say what we're seeing now is higher quality deal flow. The gap between buyers and sellers' expectations is coming closer together. And at BlackRock, we're focused on public to private opportunities, which we haven't seen for a while, but those valuations have kind of come back down to more reasonable levels. We're looking at consolidation opportunities, buy and build strategies, corporate carve-outs, and in some cases, special situations investments where there were investments that haven't performed that well, and we have the opportunity to come in and buy those companies at attractive multiples. So I think many GPs are like-minded. 2023 is going to be a very, very interesting vintage for private equity, and we're excited to have a fund in the market to take advantage of that.
All right. And what about Apollo?
Yeah, it's a great question. Those are great comments, Tom. I think from Apollo's standpoint, we echo a lot of those. We thought, we had monetized in some previous vintages, and again, private equity funds are, vintage delivered, finite offerings, raise capital, and then operate, and then liquidate the funds and do another vintage. So in past vintages, we actually took advantage of a lot of that in 2020 or 2021, monetizing assets in previous funds. We came to market with Fund 10 in 2022. We've gotten commitments of $15 billion of a target $25 billion raise, and we see the market, just like that. You may have heard, if you follow us, I know Faraz called me when Mark Rowan, our CEO, said this. He was just at a Bloomberg event in September, and he said, quote, "We apologize for nothing." And I think what he meant by that was, what we do in private equity and what separates Apollo from other groups is the way we come to market with a fund. We really have three real prongs of how we approach the private equity market, and some of them bleed over with BlackRock's positioning, and so that kind of makes us partners in some ways, historically and probably going forward, is we do leverage buyouts, and that's just a straight borrowing money to buy a company. We do corporate carve-outs, and I can get into some of that later maybe, and then we also do distress for control. And that's probably our biggest differentiator from the other stalwarts in the private equity market and the flagship fund type vehicles. And we've actually gone through some of that already. A few examples just recently is in Fund 10 that we're currently raising money for, we've committed to take a company private, Atlas Air. We actually just announced one in January 31st, Western Digital as well. But also an interesting debt strategy to get control of the equity as a take private. So we're seeing, to echo Tom's comments, the same type of themes out there in the general market, and we think access to capital is going to be important, being able to finance that. We think we're incredibly creative, leveraging our credit business, which you'll hear from them later, Mohammed and his team, but also that ability to access the distress for control side. And we think in this market, you'll probably see Fund 10, at least at the front end, as we deploy in 2023 and 2024, probably be heavier in the distress section of our composition. That may change a little bit as we get into 2025 and 2026, because we don't want to have a straight distress for control portfolio. Yes. That's bigger risk, but we like to have a blended portfolio. But at the front end, it'll probably be more heavily distressed. Okay.
Now, let's talk. You talked about your secret sauce. Both of you talked a little bit about your secret sauce. Where do you see meaning you also mentioned 23 vintage, both of you mentioned that. Help everyone understand, when you say 23 vintage, what does it really mean? And why is it valuable to invest in private equity this year versus last year?
Yeah, sure. I think, again, just to outline the way private equity funds work, or maybe ours operates, is it's a commit and call structure. So you would commit your capital to the fund in 2023. You allow us as the general partner to call that capital typically over about 4 years. So we'll call it in chunks as we find opportunities. And in terms of 2023 vintage, our positioning on that is this is an attractive time to commit to the space, because per Torsten's comments, what all of you have already probably been thinking, Tom's comments, Faraz, what you'll hear later today, we think the credit and equity markets are going to be choppy moving forward, probably for some time. And we think that creates an opportunity to go out there. And so what we want to do is methodically, patiently, but with conviction, deploy capital. So what we are trying to avoid actually is having a 2023 fund. We don't want that. We want to deploy capital over the next 36 or 40 months really strategically. Typically the way we do that in a fund is we'll probably have 20 positions or so in this portfolio, roughly $1 billion equity check at about a 4x on leverage. So that's the way that we sort of do that, but we want to be very methodical in that. And of course, we want to have diversification in terms of how we source those deals, not just distress. We don't want to just say, hey, everything's on fire, let's go buy it. That isn't what we do. It's, I'll get to an example, but one was a Yahoo corporate carve-out that we did in Fund 9. We bought that from Verizon Wireless. That was a transaction that occurred 2019, but it occurred after 10 years of working with the executive C-suite management team at Verizon about how Yahoo was not a core business for them. And so you'll see us make moves. It isn't just because, oh, hey, spreads have widened, there's choppiness, let's take them private. It's not that simple. It's very thought out.
And Tom, for you, what does 23 vintage mean? And how do you see taking advantage of the 23 vintage?
Sure. I mean, very, very similar. So from our perspective, we're in the market with our Private Opportunities Fund 5, and we'll have a 4-year investment period. So similarly, we'll pace the capital in an appropriate manner, but we are seeing pretty interesting opportunities right now. We'll announce our first investment likely within the next few weeks in the fund. So this is a pure 2023 vintage. The difference between, I think, what Apollo is doing and what we're doing is that ours is a bit more diversified as it's a co-investment fund. And what I mean by that is basically what we're doing is we're making investments alongside other leading general partners in the private equity industry. So across regions of the world, different strategies, buyouts, growth, special situations, et cetera. And our goal is to basically partner with the best owner operators in the industry and build a portfolio of those investments. So we'll have 35 to 40 investments when it's all said and done over a 4-year investment period, leaning into those various strategies and opportunities. And we'll build a portfolio of what we believe are the best risk-reward opportunities.
Okay. Now let's talk, we talked about the benefits of investing in private equity. Let's cover some challenges of investing in private equity. It can't be all rosy. There's got to be some challenges of investing. So what challenges do you both foresee in the next few years? And Tom, why don't you take that first?
Sure. So when we think about challenges, I mean, there was a lot of discussion around inflation and clearly the threat of a recession that impacts every industry, not just private equity. But we're certainly focused on that. Right now, we're paying careful attention to the debt markets and the availability for capital, particularly in the larger kind of mega end of the spectrum. As I mentioned, public to privates are pretty attractive right now, but you can only get one of those transactions done if you have the debt to be able to finance it. So that's an area that we're focused on and could potentially slow activity until the debt markets open up a bit more. The other area that we're really focused on right now is just companies' fundamental performance. And generally, company performance balance sheets have been pretty strong. Companies have been growing, they've been very profitable throughout the course of 2021 and into 2022. I think the question is, these businesses have benefited from the rapid restart in the economy, a lot of pent-up demand, so top lines have been increasing at a pretty consistent rate. And companies, while they have faced a lot of inflation, you've probably seen this in many of the businesses that you own as entrepreneurs, you may have been able to pass through price increases without too much trouble. I think the challenges in 2023, or one of the questions, if we do start to see some dampening of demand, right? So top line pressure, and then if businesses are not able to pass through those price increases, reduce pricing power, maybe inflation doesn't settle down quite as rapidly as we hope, what that will lead to is margin compression. And so some businesses will face sort of a cash squeeze, which actually could be an opportunity for some private equity investors, distress for control, special situations, et cetera. The other thing that I would mention, and it's just really important, there are literally thousands of private equity general partners and funds in the industry. And what you'll see is that many of them are actually newer, they're upstart. And so many general partners and many partners or principal level professionals may have actually never invested through a cycle before. And we think that it's really important, from your perspective, from your advisor's perspective, to really understand the groups that you're investing alongside. Whether it's Apollo or it's BlackRock or others in the room, these firms are cycle tested. I think that's really important in the market we're going into.
That's a very important point, that, hey, you want to invest with a manager who has gone full cycle. What does that mean is that they've taken money from investors, invested the dollar into businesses, buying businesses, and sold those businesses, returned the money back to investors, of course, hoping for some significant profit. That's why you're investing in private equity. And these managers have an enormous track record of showing that. So we'll talk a little bit about that track record towards the latter part of this discussion. Steve, from your point of view, what are some of the challenges? Many challenges could be beneficial as an opportunity for you and other private equity firms as well. So what are some of the challenges do you see in 23 investing in private equity?
Yeah, I think, obviously financing is difficult, access to financing. And so having a balance sheet, a proven track record, the ability to access capital from our debt partners is important. Being able to structure deals in an interesting way that helps us capture the value, enter at a great multiple. I mean, the major thesis out of Apollo, you heard Torsten say it a few times, I think, on that recording, is purchase price matters. Mm-hmm. And that, our argument is how I was trained when I got into financial services 15 years ago out of college, is you make your money on the buy, how you acquire the asset. And if you own real estate, I think there's some businesses in here, your entry point, your basis is a big determining factor, that also the amount of leverage that you use. So we're looking at the market today, and Torsten, that was a great recording. I thought there was a lot of insight there, and I hear it a lot from him. I also think it's really murky out there, not just for you all, and Faraz and Rizwan and Accretive, but also for us. And I think also BlackRock and other sponsors. You really have to stick to your core business, and I think what we're really trying to do is, I think it cuts both ways. That murkiness provides a little bit of hesitation, which helps us in a good cadence to deploy capital responsibly, but also to really underwrite the businesses. When we look at buying a business and taking it private or making it in part of our private equity company, it's just not that business. We look at, okay, who is this business? And we're typically buying large cap companies, right? So these are $5 billion roughly acquisitions a piece. So multiple business lines, long history. We're really looking for a really good business, cash flowing, just a very bad balance sheet. And how do we write that? So we're looking at everything from who are their clients, what do their businesses look like, who are their vendors. The supply chain thing, we just went through that supply chain crisis on the back end of COVID. What does it look like for them getting their supplies from their vendors and their supply chain to deliver their product, to then sell it to their customers? Who are their customers? What's the lifeline of those businesses look like? Can we build a portfolio company around that? The underwriting and diligence that's involved with that is really deep and very sophisticated. And so to Tom's point, I think we have we'll get into track records later, but our track record is top quartile over 30 years since we've been in business. We have high flyers and we have bottom returning funds. We've learned a lot, and I can tell you one thing we've learned that you will not see in Fund 10 is energy.
Good.
Believe me, we do a lot of energy investing. In fact, as a firm, we're investing, I think it's $50 billion in the next 5 years into the energy transition. So we do that. That's a big part of what we do.
Energy transition and energy are two separate things, but...
And we also, mid-cap and oil, and we do a lot of that. not in a flagship private equity fund, because part of the challenges of private equity, to your question, are the lifeline. This is a 10-year hold, a lot can change in the next 10 years. And so the lifeline of these funds is different. We return capital at different times. So those are some of the challenges and things we think about in this market. And again, it does cut both ways. It creates opportunity, but you have to be able to get there.
Wonderful. Now let's dive in slightly into under the hood of your previous funds, and let's talk a little bit about, can you give us a few examples of, hey, your funds, how did you solve problem? Because private equity is about solving a problem. You taking a company private, as Silver Lake did to Dell, as Apollo did to Yahoo. Let's talk a little bit about how were they able to solve the problem for their clients. So, Steve, let's start with you. Share an example or two where you guys have solved the problem for the business owner, whether taking them public to private or from a owner who couldn't process it well, run the business well. You guys turned it around and made an exceptional return.
Yeah, I'll stick with Yahoo just because I've mentioned it a few times. It's in our most recent fund, Fund 9, that we finished raising equity for, I think, in 2018. Deploying through 19 and 20. Yahoo was owned, and that actually includes America Online, and you may not believe it, but that still exists.
Yeah.
And we bought that. Verizon had owned it for about a decade, and our team had been telling, David Samber, who heads up private equity, had been talking to Verizon for a long time about how this isn't a core business for you. Yahoo isn't what you do. And they were having a really difficult time integrating it and making that work together. It was pulling their stock down. And so they took Yahoo, which was really about 7 different business units, and they were trying to sell them in pieces. 2 or 3 pieces here, 1 piece here, and they weren't getting the valuation, and none of the buyers would really pay because they didn't think they were getting enough value. At the same time, none of the suitors were really able to take down the entire company. So we watched that transaction patiently kind of stumble. And so then we came to them and said, okay, here you go. We'll give you $5 billion and we'll take the whole kit and caboodle. And so they took that and we put down $1.7 billion in equity and we financed the balance. And while we were in escrow, we broke, in our diligence and as we're working things out, we broke Yahoo into 11 different corporate business lines so that we could really operate them individually with less confusion. And what we actually did is we took one of those business lines, just one, so we have 10 more left. And we sold one while we were in escrow to Yahoo Japan. And in doing so, we actually took 50% of the equity we put down, the $1.7 billion, so call it $800 million. We took $800 million back off immediately. And so we were able to really, that investment, the Yahoo investment in Fund 9 will be our top private equity investment in the history of our firm. That investment itself is already up 35%, and as a derivative of that, Fund 9, we just got the marks on Thursday, that's up 25% year over year. And so those are the type of things we're able to do. In our mind, Verizon isn't just someone we buy a company from and move on from. That's a strategic partner of ours in terms of, like we've been talking about the credit markets. We have a $400 billion direct lending credit platform. We're probably the largest direct private lender in the world in alternative space. So Verizon's a group, when they need capital in this environment, you really can't go to the public markets. So they're a client of ours. And so we did solve a problem for them by freeing up a lagging asset on their balance sheet.
Mm-hmm. And got $5 billion for Verizon to reinvest in their core business.
That's right.
Okay. Tom, can you, from the BlackRock point, can you share an example or two where you articulate your business strategy?
Sure. Our value add to you as clients, I think, is really to have built many, many GP relationships around the world and deliver you access to those general partners and to some of what we believe are some of their most interesting transactions. So we cast a wide net, but our objective is to be the first call when that general partner needs to bring a partner into their equity syndication process. And typically firms appreciate working with BlackRock, certainly based on the brand and the fact that if they take that company public at some point in the future, BlackRock probably will emerge as the largest investor on the public side. But that aside, our team can execute with what we say speed, certainty, and scale. So we can commit anywhere from 25 million up to 500 million in a single transaction. We can be very nimble and we can be opportunistic. So in our prior fund, Private Opportunities Fund 4, we've done some smaller transactions and we've done some very, very large transactions. On the smaller side, just to provide an example, there was a lower middle market fund focused on the kind of retail and consumer space that called us up in around April or May of 2020, when everybody was sitting at home trying to figure out what we were doing. And they presented us with an opportunity to make an investment in basically a brick and mortar retailer in the southwest of the US that focuses on athletic footwear and apparel. And as you can imagine, the last thing that was on anybody's mind, especially at that point in time, was investing in a brick and mortar business that had their doors closed. However, we took a good hard look at the business, very attractive, sticky customer base, and we decided to make a sort of a rescue financing investment there to come in, shore up the balance sheet, and to provide the company the liquidity it needed to be able to buy essentially inventory for the fall selling season. We made that investment. We had a preferred structure, very attractive security for our investors from a downside protection standpoint. And we felt like maybe we'll just turn aside from e-commerce at the moment and invest in this brick and mortar retailer. It actually couldn't have worked out better. The rapid restart of the economy, doors opened back up, people were outside, they were buying tennis shoes, athletic apparel, and long story short, we actually were able to exit that investment in about a year, and we sold it to a major strategic that everybody in this room would be familiar with for about 3 times our money. So that's a realization in the POF portfolio that we're proud of. On the much, much larger side, an unrealized investment is an investment that we made a little over a year ago in the leading provider of vehicle glass repair and replacement services. So if you've ever gotten a nick in your windshield.
I did recently.
You probably use this company. And if you have an EV or if you have a luxury car with a sophisticated windscreen with the sensors and the cameras in it, you'll also know that to replace those is significantly more expensive.
I recently realized that too.
Because it needs to be calibrated in a facility. So long story short, another major New York-based buyout firm that we have a very, very strong long-term relationship with, we were one of the first calls where they wanted to recapitalize that business. We came in alongside a major sovereign wealth fund and one other private equity general partner that's very well known and respected up in San Francisco. And we were part of the group that catalyzed that transaction. So again, interesting business, strong free cash flow, downside protection, and really recession resilient. We were talking about the roads earlier, whether it's around here or across the country, you're gonna get nicks in your windshield and you're gonna need to have it replaced. So we like that kind of business as a core position in the fund.
So just as a show of point, there are 4,400 publicly traded stocks that trade in the US. 4,400. Anyone wants to guess how many private companies are there in the US?
Oh, geez.
Any guesses? 3 million? I heard 3 million. Any other guesses? There's almost 12 million private businesses in the United States. So when you talk about investing in equity, equity is ownership in a company. So when you're talking about owning a business, your opportunity on the public side is to own 4,400 stocks. And go and buy any mutual fund, you'll get a sliver of those stocks in every single mutual fund or ETF. You'll get 80% of the return in S&P during the peak of during the pandemic came from 7 stocks. 80% of S&P and NASDAQ's return came from 7 stocks. If you own those 7 stocks, hallelujah. If you did not own those 7 stocks, you were a lagger. Your equity investment was a lagger. The better way of owning a huge sliver of the market is by investing in private equity investment. Why? Because private equity gives you access to so many different varieties of these businesses. And hence we are having this discussion with our managers about that. Now let's talk a little bit about what clients like the most, returns. Can you share a little bit historical perspective of what have your returns been in the last 2+ decades that you guys have been operating in this environment? Tom, why don't you start?
Sure. If you look at our returns, even to our prior fund, Fund 4, we have about 35 businesses in that portfolio. We started making investments in 2018, 2019, and then interestingly, we talk about private equity being a journey. When you look at that fund, it invested into a 100-year pandemic, a massive market run-up, a massive market rundown, and we still have 5 or 6 years of harvest period to go here. But that fund, the realized investments, I highlighted one, but in aggregate are generating in the 25% IRR range, and on a total fund basis, sort of mid-teens net returns. But again, a lot of value creation happening in that portfolio. When you compare that fund to the public markets, it's actually outperforming in the neighborhood of 14 to 15% on a net basis. If you go back on our co-investment platform and you look at our returns over the past decade or so, we're outperforming the public markets between 900 and 1,000 basis points, so 9 to 10%. In general, institutional private equity investors typically look to outperform the public markets by 300 to 600 basis points, or perhaps a bit more depending on the strategies that they're in. So we're happy with the performance that we've delivered.
So let me just explain what, not explain, but let me just highlight what Tom said. Their private equity performance has been anywhere 9 to 10% average annualized return higher than the public markets. Okay, in Fund 4, on an average, private equity is looking to return 5 to 6% a year higher return than the public markets. So then the question becomes, why would you not invest in the public market? Is liquidity the only concern? And I'll steal BlackRock's statement, which I went to, Rizwan and I we were in New York, and we went to BlackRock's education seminar, and they said something very profound which has stuck with me, and I always say it to my clients. You do not need 100% of your money 100% of the time. So what that means is that you can park some of your money long term in an illiquid fund. The second data that I would share, and I keep repeating this over the course of the day, the second data is, on an average, let me pose this question to everyone. On an average, how many months or years does an average investor hold a mutual fund or an ETF? Any shout out if you want to take a guess. How many months or years? 12 months or 12 years? Sorry? 12 years, okay. Anybody else? The average is roughly about 4 to 5 years. On an average, an American holds their mutual fund and ETF for 4 to 5 years. That means you're not trading daily. You're buying and holding for 4 to 5 years. That is when investing in these kind of investments might be a good idea for you guys. With that notion, can you share a little bit about your historical perspective?
Sure. I think, again, we've learned a lot over our life in private equity, where not to go in our flagship funds. And, just plainly put, I think what Apollo does real well is, we would also say purchase price matters, but in private equity specifically, we trade for complexity. So we look for that, Yahoo as an example, we look for the very complex, sophisticated deals where you have to be more patient and more timely and really understand the core business of the business you're buying and what the growth platform looks like and who their partners are and how you're going to finance it. So through that process, I think if you look back over our life, our return metric is 39% gross annualized IRR with a net return to investors of about 24.5%. So our institutional partners have been very happy with that. And to Tom's earlier comments, we have brought that to the high net worth and mass affluent markets just recently.
So yes, again, I want to be cautious in this. Yes, the historical return has been phenomenal. Our view is if we get a mid to teens return, we are thrilled. Their returns historically have been much higher than that, but if our private equity portfolio yields a mid-teen returns, we are very, very, very high to mid to high teens return, we are thrilled. Okay, so yes, they've returned much higher than that, but our base case scenario is that we would like a mid-teen returns from these kind of portfolios. Last 5 minutes of this session, let's talk about your funds. Apollo has Fund 10, and BlackRock has Fund 5. We've invested in BlackRock Part 4, and we can attest to it. Our returns in the 30% range in the last 4 years. Annualized returns been in the 30% range in the last 4 years. Let's start, Apollo. Can you talk a little bit about Fund 10? What should we expect from Fund 10, and what is the target return expected for Fund 10?
Sure. So just to finish up, we are $15 billion into our $25 billion raise. We'll probably close our equity raise around the end of the second quarter or so. We're expecting to do that. Back to what we've experienced in 2022, with one of the challenges is, everyone from mass affluent, high net worth investors all the way up to large scale institutions and sovereign wealth funds. Their liquidity has been pinched by a 25% drawdown in the public markets. And so, as you can imagine, they're taking more time figuring out how much liquidity they have to contribute to a private-only strategy, a risk-seeking asset class. And so our expectation, though, is that is turning. 2023 has heated back up in terms of where people are looking to commit dollars. So we expect to hit that target of $25 billion at the end of the second quarter. And then I think we'll probably see a few more acquisitions announced this year, maybe 2, maybe 3, but we'll probably start calling capital from investors towards the tail end of the year. And then our capital call will probably be over the next 3 to 5 years in maybe 2 times a year. We typically use umbrella financing, and then we backfill that with capital calls. We want to make that easy for the investors to manage the capital calls. And then I would expect, the way that we invest is, in a risk-seeking asset class like private equity, it's hard to say that we invest with downside protection, but we really do try to do that. And one of the ways we do that is when we underwrite a business to purchase, it's our credit team says this as well, you'll probably hear Mohammed say it later, is we're dollar good day one, meaning that business is a cash flowing business. And the net return day one from our entry price, our debt covenants on it, is a 20% net IRR that day. And that's really what we're trying to do. And so you can expect that type of investing. And so when I say 1 to 3 investments this year, let's say we kick sideways and the base rate goes up to 5.5% and spreads stay high at 600 to 700 basis points. You might see our deployment of capital not be as strong in 2023 as we're really trying to structure deals in the most advantageous way. So,
okay. And Tom, what about BlackRock?
Sure. So for Private Opportunities Fund 5, we have a $2.5 billion target. We're about halfway there at this point. It's all institutional money in the fund, and now we have the opportunity to bring it to our high net worth clients as well. We will be in the market, basically through the middle of this year to the end of this year, so we have a little bit of time. This is our flagship private equity co-investment fund, so it's going to operate on the same strategy as the prior funds in the POF series. Again, this is global opportunistic co-investments alongside leading general partners in private companies. So we'll make 35 to 40 investments across the spectrum of private equity. This will lean predominantly in terms of geographic focus to North America, but we will be opportunistic, particularly in Europe and developed Asia. We will have sector exposure that's broadly diversified. Historically, we've leaned a bit more into healthcare and technology, industrials as well. And from a general partner perspective, we'll have probably 30 different general partners represented. So good, solid diversification. This fund will lean more towards buyouts, and within buyout, kind of the small to mid market. So we'd complement Apollo quite nicely from that perspective. We'll also have growth equity investments as well. The objective of this fund is to deliver to our investors diversification, J-curve mitigation, lower fees relative to traditional 2 and 20 structure within private equity, and ultimately the opportunity for alpha generation as well through that differentiating sourcing that we talked about, the additional layer of due diligence, and then a very, very low selection rate. At this point, we're seeing in 2022, we saw about 1,200 investment opportunities. Our selection rate is sort of running it in the 2 to 3% range. This fund, I would say, as you think about it from a portfolio construction perspective, if you have not made investments in private equity in the past, this is a very nice core. It's a turnkey solution to provide that diversification. And if you have invested in the Apollos and some of the larger managers, again, this could be a nice complement. So we're very excited about the opportunity.
So almost time up, but can you please help everyone understand when you say it's a co-investment or a private equity fund where you're investing with institutional partners, our clients who are investing in this, will it be pari passu an institutional investor, meaning whatever the return institutional investor gets, we get a similar return?
That's correct. So we have investors in the fund. We've had a number of pension plans come in, $75, $100, $135 million commitments. So you sit side by side with them in this fund. So the returns that they generate are the returns that you generate as well.
And what about you, Steve?
Yeah, exact same. Yes, we've got a few sovereign wealth partners who have put in a few billion-dollar commitments, a few large public pension funds that you would know. They're in for $250 to $500 million allocations, and your $250,000 commitment or above sits right at the same level. You actually receive the exact same return. We call capital in the same way from you, same reporting, same investor services. And I think, again, back to some of Tom's earlier comments, the democratization of the investments, the benefit is, really to the investor, is that you're getting these storied operators in these spaces. You're getting the opportunity to invest just like those large dollars, and you're being able to do it in a way that doesn't encumber you to these larger life insurance or pension plan organizations, which that's great. You're able to receive that, and so you don't have to deal necessarily with 100% equity beta in the public market.
So just to, yes, Ravi, you had a question.
As you make the investments, like your due diligence process, is that visible to the investors?
So the question is, as you make investment in Apollo's case in Yahoo, is the due diligence process visible to investors?
I think at a fund level, yes. So what we do is, we won't tell you, hey, we're looking to buy XYZ company, because that would let it out, right? So we wouldn't do that. When you would invest into Apollo, I think before you would make that decision, you would want to really have a true understanding of what do we do, how do we do top-down, bottom-up underwriting. Give me some examples of what that's looked like, deal by deal over a series of past fund vintages probably. You would probably lean on Accretive Wealth for that as well. We have third-party diligence reports probably available through them outlining our background in that, but what we don't and can't do is say, hey, we want to buy XYZ company and go to our limited partners, which would be you or any other investor, and say, here's what we think, what do you think? You're kind of signing up to follow us, basically.
All righty, thank you so much, Steve and Tom.
Thank you.
So guys, let's take a 2-minute break. Drinks and coffee is here. Restrooms are, if you go out, turn left. Restrooms are there. Let's take a 2-minute break, and let's come back for our secondary session, secondary investments in private equity. Thank you.